Gold prices rally to start the week, getting up to $33.35. That's up about $95 on the session. Recall last Thursday, gold prices traded as low as $3,200 an ounce and had since rallied, so up about 4% since that 3,200 print last Thursday. But taking an even bigger step back, gold prices have seen a decline from the all-time highs on April 22nd of about 8.5% and have gotten some of that back, but still remain about $165 below the all-time high as the market continues to look for guidance this week at May FOMC, not necessarily from a rate cut change, but from the Fed chair's press conference, which will follow the May FOMC meeting, looking for clarity on the possibility of when those rate cuts could start. Right now, the market pricing in rate cuts that will begin, a 25 basis point rate cut will begin in July. See another in September, another in October. Ultimately, 3 rate cuts are fully priced into 2025. Obviously, that may change if the Fed chair changes his tune or tries to change the market's tune. But again, seeing gold prices rally today about $95 up to $33.35. Now, what does this all mean for volatility? Well, check out that CVOL index over at cmegroup.com, and you'll see volatility had been coming off as prices were declining, and then we saw prices reverse on Thursday and extend higher Friday and Monday, and we've seen volatility move higher as prices move higher. Lastly, let's talk about positioning. What are speculators doing? Well, as of last Tuesday, speculators were exiting their net long positions, something they've been doing pretty much since the early part of February, despite the fact that in early February through the end of April, we saw gold prices rallying to new all-time highs. We saw speculators continuing to exit their net long positions. And then as we saw gold prices come off the all-time highs, we saw them again continue to exit net long positions. So it'll be interesting to see if that changes after this week's May FOMC and the May FOMC press conference. If the Fed chair has anything different to add, or if we see expectations shift for rate cuts moving down the road, it will be interesting to note how that might affect positioning as we move forward.